period after Amelia gets done speaking with us, you can use the hand icon to raise your hand if you have a question. And then you can also type your question in if you use the balloon in the taskbar. Beverly is an expert on Teams, so if you can't find something, raise your hand and Beverly will help you with it if you need it.
No, Terry's the expert.
Terry's the expert. Okay, then we'll refer everything to Terry then. I'm going to go through and call your name or your phone number as I see it. And as I call your name, please unmute yourself and introduce yourself and the company and organization that you represent. I'm going to start with the top of the list, Mickey.
Good morning. I'm Mickey Baer. I'm with Randolph Partnership for Children. And of course, we do everything that relates to young children birth to 5 in Randolph County.
Welcome, Mickey. It's good to hear you.
Thank you.
Don't see you, but I can hear you. I have a Richard. Who is a guest.
Richard, can you hear us?
We'll come back to Richard. Moving on. Tina.
Good morning. I'm at Pinnacle Bank at the Archdale office on Trendale Road. We're just a bank that has great values and customer service, and we offer all types of products to meet your need.
Terry.
Hey, Terry Floyd, owner of Act Solutions. We build custom software. We work with business processes and technology, and we also are experts in Microsoft Teams onboarding and configuration.
Morning. I'm going to go swing back to Richard one more time. Richard's being quiet. Okay. Okay. And I'm not skipping you, Susanna. I'm coming to you now. Our sponsor today is Pinnacle Financial Partners, and Susanna Hargett is the office leader at the South Main office. She grew up in High Point, and her hobbies are her church, her family, and her sons. She's a baseball mom. Baseball activities. Susanna, welcome.
Thank you. Yes, he just got signed up for a travel team. I've tried to hold off as long as I could, but I guess every weekend now it's going to be the ball field. But again, I'm Susanna here at the South Main High Point location. I am an experienced banker with over 14 years of service, and I'm passionate about helping this community and our clients. Like Tina said, our vision here at Pinnacle Financial Partners is to be the best financial services firm and the best place to work in the Southeast. We are also a values-driven organization. From our hiring philosophy to our client service, our goal is to demonstrate our value in every interaction. During this pandemic, we as individuals and as a firm have lived out these values more than ever. While our small business community has had to face such uncertainty and confusion during this time, I'm incredibly proud of Pinnacle's ability to assist so many through the PPP funding. Even though I have been here a short time, I know this is my forever home.
That's great. Thank you, Susanna. I forgot to remind everyone, we are recording this session. So just so no wild partying while we're doing the meeting. All right. So I have the pleasure of introducing today's speaker. She is Amelia Hopkins, and the topic is Economics and Market Insights, a look back at 2020. I'm not really sure we want to do that, but a look back at 2020 and what to look for in 2021. Amelia is a retired lecturer in economics at UNCG's Bryan School of Business and Economics, where she received her MA in economics. She returned to UNCG to serve on the faculty after her retirement as Senior Vice President of Granville Capital and a more than 25-year career in the investment industry. She holds the Chartered Financial Analyst and Chartered Alternative Investment Analyst designations. She has served on foundation boards and investment committees, and we have had the pleasure of hearing her speak in the past, and I am really looking forward to hearing her today. Please join me in welcoming economics investor Amelia Hopkins. And we're going to do a little seat switching. I'm going to come behind you.
Okay, can everybody see the PowerPoint? Are you seeing the
Not
PowerPoint?
yet. Not yet.
Not yet.
Don't look at me.
Did you say no?
No,
Terry's-
we can't. I can't see it.
All right, let me
I
try.
can't see it yet.
All right, let me try something else. Okay, where did my share content go? Here we go.
There we go.
Are we seeing it now?
Yes.
Yes.
Okay, and I'll just use the arrow key to,
Just
oh, I just use the wheel. Okay. Well, thank you for inviting me back. I'm delighted to join you again. And I was so pleased when I got the call and was invited back. I was honored. But I thought today we would look back at 2020 and look at some of the economic data and the market analysis. And we can speculate on how these events might shape the economy or influence the financial markets this year. And believe me, although I'm a longtime student of economics and a market observer, I do not pretend to know the answers. I am amused at these strategists we hear on television or read in the Wall Street Journal who are so confident about their predictions. In January of last year, who would have ever predicted the events of 2020? And that sort of reminds me of my friend Mark Yusko in Chapel Hill, who says, "I'm often wrong, but never in doubt." And that's the way a lot of these strategists seem to be. Now, 2020 will be remembered for a lot of things, of course, the COVID-19 pandemic, hotly disputed elections in the country, social unrest, reminiscent of the 1960s. But the real big one, I think, and what we will focus on today is this massive, mega fiscal and monetary stimulus. And we'll ask the question, could it spark inflation? And that's what the debate we most often hear about. How can you have such stimulus and not spark inflation? This chart looks back at returns in the financial markets over the past year, and we can see it was a good year for investors, certainly for equity investors and even for fixed income investors. But very surprising given the decline we saw in February and March. In fact, if you were to look back at from March, earlier in the year, like in January through mid-February, the S&P was up 5%. But then in 1 month, it collapsed 34%. So since bottoming in late March, the S&P 500 has gained more than 75%. But not all sectors in the market performed well. Technology was up 44%, but energy was down 34%. So you can see there's a great disparity in the different sectors in the market. If you're fortunate enough to own Apple or heavens Tesla, you did quite well. But if you're like me and you owned Exxon, you didn't. But overall, it was a great year for equity investors, largely thanks to Tina. No, not Tina Turner and not Tina at Pinnacle. But the acronym, there is no alternative. With such low CD rates and low bond yields, investors flock to stocks, and the equity markets did quite well. So today, let's look at some data and charts to further analyze what happened in 2020 and hopefully help us make some more informed decisions, financial decisions in 2021. The level of fiscal and monetary stimulus dwarfs anything we've seen before, and it was delivered much faster. And this certainly influences our outlook for this year and beyond. But first of all, let's focus on the fiscal side. This chart shows federal government spending since World War II. And it's just amazing. Now, keep in mind, this chart shows the federal spending before this proposed $1.9 trillion stimulus bill that's likely to be passed by Congress in the next couple of weeks. So you can see, we thought we were spending a lot. By the way, on these charts, the shaded areas are recessions. We thought we were spending a lot in 2008 and 2009 after the great financial recession. But look how government spending, of course, it took place of, increased benefits for unemployment, all kinds of PPP loans, all kinds of spending, but it just skyrocketed. And of course, this spending is not financed by increased tax revenues. It's deficit spending. And oh my, look at that deficit spending. I was alarmed when the deficit spending reached over $1 trillion back in the 2009 era, after the great financial crisis. But just look at that deficit spending. So we've had 20 years now of soaring deficit spending, which has led to a soaring national debt. The federal debt through 2019 at $24 trillion, and now it has soared to $28 trillion when I last looked day before yesterday. I try not to look at that every day. But of course, this increase in fiscal spending is to combat the loss of jobs from the COVID-19 slowdown, because policymakers did not want another Great Depression. And you can see the unemployment rate. Oh my, we thought it was high in 1981, 1975. I can remember the small town I lived in 1975 had to use the National Guard Armory to process unemployment claims because the little Employment Security Commission office was too small. But look how it quickly hit nearly 15%. So that was the purpose in all this stimulus, to combat this high unemployment, so we wouldn't have another scene like the Great Depression. I love this cartoon. Student Pelosi is being asked in her Econ 101, where do jobs come from? And she says the store brings them on a government-funded jet. Well, actually, the store did not bring the stimulus, but rather it came in the form of three phases, or three pieces of legislation. The first one, of course, was the 2020 CARES Act, which was a $2 trillion rescue plan. And I'm sure all of you are familiar with it. Certainly you bankers making those PPP loans, anyone drawing unemployment who got the additional $600 a week, all kinds. And then some folks just got a deposit in their bank account. And it took many forms. And then late in December, right before Christmas, Congress finally passed the CARES Act 2, which was a $900 billion relief package that sort of filled the gap because many of these programs were expiring from the first act. And now we have the proposed $1.9 trillion rescue plan that should be passed. I put on here when I did this, maybe passed this week, and then I heard this morning that they're hoping in 2 to 3 weeks, because there's still a lot of negotiation going on, especially with a couple of key Democratic senators like Manchin in West Virginia. So that's the fiscal side. Let's look at the monetary stimulus. Wow. I mean, it almost takes my breath to look at this chart. The growth of the Federal Reserve's balance sheet. This is since the creation of the Federal Reserve in 1913. For nearly a century, or more than a century, the Federal Reserve's assets did not exceed $1 trillion. And then in 2008, 2009, and 2010, we had quantitative easing. and the Fed more than doubled their asset purchases to 2 trillion and then to 4 trillion. And when I was teaching MBA students, I used to get all animated about this. I'm going to zoom in here because this chart going back over 100 years, you can't really see how much it moved. I'm going to zoom in from the year 2000 to present. And I would get very animated in class back at talking about the 2009, 2010 quantitative easing and how the Federal Reserve increased their balance sheet to $4 trillion. But wow, look at it now. I mean, it's just unbelievable. In 10 days in March last year, in 10 days of March of 2020, the Federal Reserve bought more bonds than they did the entire Bernanke, Yellen-led Fed. Just think about that. Now, keep in mind, this is how the Fed creates new money. We hear they got the printing press. Well, they don't print it and then drop it from helicopters. The way they create it is they buy securities, and this is what they're doing here. They're buying securities with newly created money. And as we can see on this slide, we had substantial, this is a slide showing the M2 monetary stock, how much money's in the economy. We had a substantial growth from 2011 to 2019. But we didn't have any inflation. I mean, students would often ask me during this period, why don't we have inflation? So it led us to the belief that money doesn't matter, that money growth is not inflationary. But now we're plowing new ground, as you can see in this past year. And I think we'd better keep an eye on the leading indicators of inflation. So let's talk a little bit about inflation. Here's a joke. A friend of mine owned a balloon factory, but he had to close. He couldn't afford the cost of inflation. And so while this may be humorous, it really does make an important point. Many of us can't afford inflation. For example, those on a fixed income or those making purchases in areas with higher inflation. Inflation's like a silent thief. It devalues our investments. And for those of us who lived through the 70s, we know what an impact that has on us. And it's difficult for investors. Did we save enough for retirement or long-term care? Or have we saved enough for our children's education? I put this little slide together because I thought it was a little interesting. In 1972, I went to the local hardware store and put a 13-inch black and white TV on layaway to take to college. And it cost $132. So much of my summer earnings were paying down for my TV. I saw on a Walmart ad last week that you can get a 32-inch high-definition smart TV for $128. So over nearly 50 years, the price of televisions has certainly declined. We haven't seen any inflation there. In fact, we've seen deflation and a lot of technology. But look at tuition. I got online and looked at this at UNC Chapel Hill. Tuition for the term, that's 2 semesters, in 1972 was $225. This year it's $7,019. That's just tuition. That's not room and board and books and student fees. That's an increase of 3,000% over the same time period, or an annual inflation rate of more than 7%. And by the way, the long-term inflation rate over that period was 2.7%. But one of the problems with inflation is that it doesn't happen in all segments. It's not even. If we say inflation's 2%, all prices don't go up 2%, as you can see. Some go up, some go down. And when you have higher inflation, you don't know if you've saved enough for future purchases. So high inflation makes it difficult, if not impossible, to make good financial decisions. But some people win. You know, we know that when inflation is greater than anticipated, the borrower wins because the real interest rate is lower. The real interest rate being the nominal interest rate minus the cost of inflation. And the Federal Reserve has set their target for inflation for 2%. But as you can see with this inflation chart, we've been well below 2% for much of the last 10 years. So the big debate now is, if the Fed's target is 2%, are they going to, if we see inflation popping up, will they let it go above 2% for an extended period so that on average it's 2%? Or will they start tightening up the money supply when it hits 2%? And if you listen to the speeches of the Federal Reserve presidents or the members of the Board of Governors at the Federal Reserve, I think they're leaning more toward letting it go above 2% for an extended period so that on average it's 2%. But that's always a big debate on in the financial press. And but I am seeing some signs of inflation. Back in January, I read an earnings release of a public company, which, by the way, happens to be in the furniture industry. And in that, in the press release, or in the earnings release, the company said inflation has reared its head over the last 60 days to a pace reminiscent of the 1970s, which was a little scary to me. And then I just read Monday morning in the Wall Street Journal, M2 money supply will grow at nearly 12% this year. I mean, you think about that, the money supply growing at 12%. And the comment was, it's a rate that spells trouble, inflation trouble. And then this was a chart I saw last fall on lumber prices. And the red line being 2017, the green line 2018, the blue line 2019, but look at 2020. Lumber prices really skyrocketed, and you hear that from builders and people building houses now. They say they can't build anything for less than $200 a square foot. So this chart was only through September, but last week, and this is the price of lumber per 1,000 board feet, the prices exceeded $1,000 last week. So we're seeing signs of inflation, I think. We're also seeing some problems on the supply side. We're seeing some supply side problems. There seems to be a semiconductor shortage. For those of you familiar with Corvo out near the airport in Greensboro, you know, they supply semiconductors largely to the automotive industry, and the automotive industry is experiencing right now a severe shortage in semiconductors. And then I also read another earnings release about the shortage of shipping containers. And there is a real problem with shipping containers being in short supply. So if you remember your Econ 101, rising demand, lower supply, that could certainly spark inflation or price increases. But you also often hear that gold is a good hedge against inflation. So I wanted to show you this chart. When gold rallies, it rallies a lot. This illustrates this. In the 1970s, when President Nixon took the U.S. off of the gold standard, gold prices increased 2,333%. Then in the 2000s, when the Federal Reserve started doing their quantitative easing and easy money policy, gold rallied 644%. The problem for investors in gold is that there are usually many years between these gold rallies. I have a friend who's been a gold bug for a long time, and I've told him for years, one day you're going to be right. Of course, he's right now, and he's strutting around like the prize rooster in the barnyard. But be warned, the wrong timing of gold can take decades to reverse. Are we on the cusp of another big gold rally due to all this easy money? I don't know. So how to invest? How do we invest? And this little canine friend of mine says that my advice to invest in tennis balls because they have a high rate of return. But seriously, what does all this mean for investors? Well, on the fixed income side, bonds look expensive. They look really expensive. Bonds have enjoyed 25 years of falling interest rates. And as you know, when interest rates fall, yields fall on bonds, the price goes up. It's an inverse relationship. And bond yields are at historically low rates, although Treasury bonds have rallied a little bit in the last few weeks. I mean, even junk bonds, you think, well, I could buy some lower grade quality bonds and get a higher yield than a Treasury bond. Even junk bond yields are below 4%. They've never, ever been below 4%. I used to think of junk bond yields as being 10, 12%. But keep in mind, bonds still have the power to dampen normal portfolio volatility and offset drawdowns in the stock market. So for investors, maybe they want to keep a segment of their portfolio in bonds, because if you did have a big drawdown in the stock market for whatever reason, bonds could help dampen that volatility. Bonds would rally. Equities look expensive too. This chart goes back to post-World War II, showing the price-earnings ratio. In other words, the price divided by the earnings of the company. How much are you paying for the earnings of the company that you buy their stock? And for the S&P 500, we're over 30. And that's expensive. But there are pockets of value, maybe not in Tesla, maybe not in GameStop, and maybe not in some of these technology stocks, but there are pockets of value. Look at a company like Colgate, for example. It's not a sexy, it's not an exciting company. They recently reported their guidance for earnings and said they expect to grow low to mid single digits. So let's say 3% a year. That's about like watching grass grow. But the earnings power of the company is $3 a share. And it's truly a global company with operating margins of about 22%. So that seems healthy to me. So what would you rather have? Colgate stock with a dividend yield of 2.3% or a 10-year treasury yielding you 1%? And keep in mind, although equities do look expensive, there are three major tailwinds to the equity market right now. The vaccine rollout and herd immunity will open up the economy, no doubt. We could have a real surge in GDP. This new massive stimulus package will certainly help increase aggregate demand. And earnings estimates are actually moving up. So there's still some tailwinds to the stock market. Are we in a bubble? Clearly, there are some asset bubbles in this financial markets, especially with certain stocks, some bonds, and even some real assets. So beware. Our John Husband, who manages some Husband mutual funds, made this quote earlier this month. One of the hallmarks of every bubble is a loss of interest or ability of investors to distinguish between investments and speculation. And oh my, I think you've certainly seen that in Bitcoin, Tesla, GameStop, where those investments are just speculation. So what is my forecast for 2021? For those of you who have been present for my presentations before, I usually made some pretty concrete forecasts on the economy and the financial markets. But this year, my forecast is this. Seriously, we know that hindsight's 20/20. But so looking back on 2020, I hope maybe we can make some more informed decisions. But I'm here to say, I don't know. Who knows? But just to raise your awareness of some of the things that's going on in the market, I hope I've done that today. And I'd love to take your questions now, if you have any.
Do you want to minimize that so you can see if
Okay.
anybody?
Mm.
Do you know how to do it?
No, I don't. You just move right on
Let's
over
see if I
there.
know how to do that.
We're gonna fix the screen.
Maybe.
Oh, Lord, you got me front and center.
I know, Terry. I don't know how to. I thought I had you on gallery.
Not sure what happened.
Oh well. So Amelia, if you want to be over here in case people have questions,
No,
or
any
can they
questions I
see
can
you?
shout.
Yeah, I have a question. I'm curious to what your thought is on negative interest rates, and is the possibility of seeing those ever in the United States, or when?
Well, we've certainly saw a brief hint of them earlier in the year, and we've certainly seen them in Europe. Now, when we talk about negative interest rates, are you talking about negative nominal rates, where the rates are actually negative, or are we talking about negative real rates? In other words, the nominal rate minus the inflation rate. I think we'll certainly see negative real interest rates. I don't believe personally, from all I've read, that the Fed will let us go to negative interest rates.
That makes sense. So then at some point in time, the amount of money that we're spending, we can't drop rates any longer, right? If we maintain that policy, then I guess the question is, what happens eventually when all the debt catches up to us?
Oh, yeah, that is an issue, and that's what I'm concerned about. Now, at my age, I'm not sure we'll see it in my lifetime, but eventually it will. I think the only remedy for it is to inflate it away. You know, so you've got $30 trillion in debt, but if inflation's so high and the dollar's not worth much, then that's not that big a debt load, and that's a serious problem. I don't think politicians can raise revenues to pay off the debt. That would just there would be no political appetite for that, and it would slow the economy down too much to tax people at that level to pay off the debt. So I think the only solution would be to inflate it away.
Excellent, thank you.
Which is scary. Now, whether we'll see it in my lifetime or the next generation or the next generation, I don't know.
Well, it feels a little bit like the plan, I don't know if this was intentional or if they just kind of backed into it, is by depressing interest rates so low, it essentially forces people to not be able to save money in a traditional sense, and then forces it into some level of risk in the market, which has also helped prop up the market. Is that correct?
That's exactly right. And the Fed's been criticized for that. But then on the flip side of that coin, they've been criticized for not doing more, that they should have done more after the 08-09 financial crisis, because the recovery was so tepid. But those who subscribe to the modern monetary theory say, hey, it doesn't matter.
Yeah.
I think it does matter.
Yeah, because as I'm thinking about retirement and what that looks like and thinking, so there's no such thing as really safe investments, quote unquote. So where I can't just put my money in savings, right? Because it's not going to earn anything. So then I'm stuck with, what are my options? I have to accept some level of risk, right?
That's true. And
Which
that's
is
why,
unfortunate.
and that's why I think Bitcoin's rallied so, because folks are seeing it as another place to store value that will not go down like cash would. And I think that's helped fuel Bitcoin. But I will say, I think there are pockets of value out there in some, in the equity markets and maybe in some real assets.
Yeah, and I think, and I've really been looking a lot at dividends, so I'm glad you mentioned Colgate. I own quite a bit of Duke Energy stocks, so I think maybe, drip stocks or, in blue chips and stuff are an alternative to at least have some security in what you're getting your return as.
Yeah, it's not exciting, it's not sexy, but it's maybe something of interest.
Amelia, I have a question about our local economic environment. When you listen to the local, the national news, they're talking about the high unemployment rates, the hundreds of thousands of jobs lost. And we're certainly seeing businesses closing here, but not at that level. We, from what I see, at least here in the Triad, we're doing okay.
Yeah.
What do we have that the rest of the country doesn't have? Why are we faring better?
Well, for one thing, the North Carolina economy, and that's interesting you mentioned that, because I haven't looked at a lot of data from North Carolina, and normally I do. I look at the Federal Reserve data in the Beige Book, but I haven't done it. The North Carolina economy is better diversified. Although I will tell you, one of my good friends is Lynn Minges in Raleigh, is head of the Restaurant and Tourism Association in North Carolina, and she just gives you some dismal numbers. So it's interesting when you look at tourism and restaurants, how much they're down. It's staggering, but yet beach and mountain property is skyrocketing. So to answer your question, we're better diversified, so we haven't been hit like some pockets have. And the biggest employer in North Carolina are the healthcare, and that's done well. Walmart and healthcare, Lowe's, headquartered in Charlotte, they've done very well. I mean, Lowe's posting 24% comp sales. I mean, their comparative sales were last year up 24%. Wow. But then you go to Dillard's at Four Seasons Mall. You ride by the Sheraton at Four Seasons Mall, which parking lot's always been full and it's empty. You ride by the Printworks and O. Henry Hotel in Greensboro, and the parking lot's empty. So it's a very interesting time, very, very different. Now the bankers, I'd be interested in hearing from the bankers how they feel about the economy. Are you seeing loan loss reserves having to be increased? I don't think so, right?
That's right. Everything's low.
Well, thank you for asking me to join you again.
Let's give Amelia a hand. Thank you, as always.
All right. Now we'll do the seat rotations again. All right. Thank you, Amelia. I really did appreciate it. Very interesting. I always look forward to hearing you.
Oh,
I really do. We are going to now draw for 2 door prizes. Beverly is frantically doing that really fast. Mickey and Terry. Y'all get the door prizes. I have no idea. Who said, oh, you're clapping. I thought I heard somebody say, what is it?
Wonderful.
If you want to, you can call Beverly and arrange to pick them up or get them delivered. Oh, it's something that can be delivered. That'll be great. Following that, let's see. Announcements. Just a quick reminder of our upcoming events. Holy wow. About 3 weeks from now is March 13th and 14th, and that's our junior tournament at Holly Ridge Golf Links. We get about what, 400 to 500 people in. Speaking of tourism and restaurants, that's our first golf event for this year, and that should be, it's always fun. And of course, we will be looking for some volunteer help at it. March 18th is our next Coffee and Conversation, and that is still open. We are looking for someone to sponsor that. So if you know of anybody, or if you personally are interested in that would be great. If just a couple of housekeeping things, if you're not receiving the Chamber's weekly newsletter, but you want to, please call the office or email Beverly or Jonna, and they'll be happy to get you on that newsletter email list. And finally, if you're not a member of the Chamber, you're welcome to talk to Beverly. You can talk with me or any of the staff, and we'll be happy to help you become a member. As you can tell from today, we're a very engaged organization, and our goal is to really help all of our members thrive in this interesting times. Finally, this recording has been posted, let me get this. This has been recorded and it will be posted. Not sure yet if it's going to be on YouTube or Facebook or on the website, but we will make it available. And so if you have friends who would be very interested in hearing what Amelia had to say, we will make sure that you are able to share this information with them. Beverly, is there anything else? I hope everybody has a great week. Thank you for participating. It was nice to see some faces I haven't seen in a while. And I hope everybody has a great week and go out and enjoy the sunshine. Thank you.
Thank you, Beth.
Take care, guys.
Enjoyed it.
Thanks.
Thank you.
Yeah, I'll let you navigate.
Well, let me get out.